Welcome to Money Club Mondays. What is today, Jack? I don't even know. June 27th already.
27.
Holy cow. Can't believe that. Almost the 4th of July. So welcome to another Money Club Mondays. Today's going to be all for the lenders. So if you have money, you're looking to lend it out, or you're just curious about what's going on with the real estate market, that's why I have Jack on today. Jack's been a part of the Private Money Club since its launch, since its beta launch last year. I've known Jack for several years prior to that. And he has a really cool story, kind of how he got into real estate full time and the different types of real estate that he's done and what he's doing right now. And we've had a lot of Private Money Club members that have lent money to Jack over the last year and a half or so. And everybody's been super happy. So I just asked Jack to kind of come on. And I was telling everybody before you got on, Jack, that we were talking last week on the phone, and you were just telling me about the markets and what you guys are doing to kind of, make sure you're staying on top of it and all that good stuff. So I think it'd be a great conversation today. So thanks for taking the time and hopping on here, and let's talk a little real estate. What do you think?
That sounds great. I appreciate it, buddy. Thank you. I started off probably at this point closer to 20 years ago. I came across the book Rich Dad Poor Dad, and I was going the path of becoming a firefighter at the time. And actually, I was a firefighter at the time, and I read the book, and it was just a very eye-opening. It was just a very powerful book, and just opened up my mind to thinking and looking things a lot differently. Because I was trying to go the path of everybody else, get a job, put money away into my retirement. I had a pension at the fire department, but I had like the equivalent of a 401k, which was optional, called the 457. And my uncle was like, he was a retired police officer, and he like beat it into my head to put money away from day one. And so I started putting a quarter of my paycheck, then I upped it to a third of my paycheck and put it away. And so I had the safe route. I had a locked-in pension, healthcare benefits, and I had this other retirement. So I figured I should be good. So read Rich Dad Poor Dad, and it had just a lot of things just opened my eyes. So started becoming interested in real estate, and I had time that I could invest. So I went initially the path to becoming a custom home builder. So I'm building homes now, but 20 years ago I started off building custom homes. I had no background in it, so I went on Amazon and I purchased every book on how to be a general contractor, how to build a house, how to wire a house, and literally learn from reading and driving to job sites. So I built homes for a number of years, and then 2008 occurred. There was millions of bad loans that were being provided to lenders. Right. They would start off at a lower rate, and then the rates would climb up exponentially and midterm of their loan. They were doing a lot of things that, looking back, it's just crazy. Like, you could get a home equity line at 125% of the value of the home. They would do drive-by appraisals. They would do things. They would qualify people that had no business in being qualified for a loan. So when that happened, I had to kind of readjust and figure out where we're going. And at that time, the prices of single-family real estate just bottomed out. At least I thought they bottomed out. So I purchased the first property. The purpose is a rental house for $60,000. And previously those homes sold for like $120,000 before. So I'm like, great, I bought it half off. Well, the market continued to fall to the point that we're buying houses as low as $4,000, and they were destroyed. But we would go in there, fully rebuild them, built a rental property portfolio, and literally did everything wrong for years and years and years, and made tons of mistakes, lost lots of money. But I learned through that and got to a point we really got the business really dialed in. So, but I don't know, probably about 13 years, did single family rentals, did house flips, did general contracting work, and then had the itch to start to transition into apartments. Spent about a year understanding the value-add multifamily space and how to evaluate apartments and how to take what I knew in the single family houses and take it over to apartments. And did that for, let's say, about the last 4.5 years. We built a portfolio of about north of 700 apartment units, and really happy with that. And then around 2020, the price of the real estate started really exponentially increasing. So I started selling off all the single family homes. Apartments we were getting kind of squeezed out because the prices were going up. But the opportunity that really made a lot of sense was to go back into building homes. So I've got two amazing partners that live in Florida. We partnered together, and we've been building homes for the last couple of years down in Central Florida. So that's kind of a quick, long story of how I got to where I'm at today.
Yeah, I mean, I know through that experience, with you buying all the multifamily apartment complexes and everything, I always thought that it was interesting when you pivoted from that and you started building the houses again, especially down here. And now you guys have done so many of them. And but when you look at the market, I mean, that's something that I've always, appreciated that you are able to do is go where the market allows. Because we talk about it all the time. Like when it comes to real estate investing, especially investing, that you can make money in any market, up market, down market, sideways market, there's just different strategies you have to follow. So when you guys
Yes.
were buying the apartment complexes at the right cap rates and everything, and you're making your money there and doing the value add and all that, and then you guys were killing it. And then you see the opportunity there for single family, and boy, did you get that right, because single family homes
Yes.
have just gone crazy the last
Yes.
couple of years. So you've really been able to get into that and solve a problem, right? I mean, that's what investing is all about, is solving a problem. And a huge
Mhm.
problem we had here, especially in Florida, is inventory. There's just no houses. I mean, it's like that the whole country, but especially here in Florida with, I mean, how many people a day are moving here right now? You were
It's
telling me?
about 1,500 people per day, and you living there, you can see
Yeah.
the traffic pattern. So
Oh,
take the
yeah.
news articles aside and just look at the traffic that you have down there. It's a clear indication of how many people are relocating.
It's like, so we used to have like, oh, good, the snowbirds are all gone in the summertime. Like we can get back into restaurants without a wait and go drive down the road without traffic and everyone's gone in the summer. It's not like that now. Like it's still season. Like nobody left or everyone's here now full. I don't know what happened, but so you go out and everything's packed. There's traffic everywhere in the summer right now. And it's hot as hell. I know it's hot across the country, but it's like, man, things have definitely changed. So you guys were spot on with that. And so let's just type in the chat thing, with all of your experience in real estate, and you've been through the ups and the downs of it and all of that. I would love to get some of the, audience that's watching right now. Like, I'd like to hear what their thoughts are on some of this. Like, so do you guys have any questions, like about the market? I see Craig is commenting. Craig, I actually called me last week to ask me my opinion on the real estate market. And that's one of the reasons when I connect you with you, I was like, well, let me talk to Jack about it, and decided to, definitely have you come on today. So I want to talk more about, the projects you guys are doing, the housing, the opportunity for people that want to lend money and get involved with those deals. But I do want to talk about the market too. So if anybody's on right now, you guys have questions or opinions, put them in the chat box and let's talk
Sure.
about it. You have a wealth of knowledge here with Jack and experience. So let's take advantage of that. But while they're typing that in, Jack, I mean, so let's talk a little bit about, what you kind of see happening right now. I mean, what are you guys experiencing now? What are you seeing in your business?
Over the last number of years, we've seen this massive shortage of housing inventory, and a lot of that stems back to 2008. When 2008 occurred, for the following subsequent years, there were millions of houses that were not built that should have been built, but because of the market conditions, they weren't. So that got us to a point that we had this finally this backlog that kind of hit us, where it gets, depending on the source that you're looking at, anywhere between 4 to 8 million homes right now that we're short on, with more of a focus on like first and second time home, properties that are a price point that are more appropriate for like first and second time home buyers. So, that's kind of led us to the point that we're at. And the last few years have been very interesting. The COVID happened and interest rates got completely bottomed out. And, at that time, pricing was starting to go up. And that's when it kind of kicked everything up from going up at that point. And the rates that we had seen at 2.5%, that was never sustainable to maintain rates at that rate, but people thought it was. There's a really interesting chart that I have where it shows the average rate year over year, starting back in like the 1970s till today. And like 6% is in kind of the average normal range that we've seen rates. But as rates have been going up right now, it has caused the market to kind of cool off a little bit. And when I say that, that's a very generalized statement. One thing to realize with real estate, every pocket, every city, West Coast, East Coast, California, Florida, are going to have different dynamics. People are either moving in, they're moving out. There's weather, there's political reasons, there's tax benefits. And the reason we focus out on Florida is because there's a massive migration of people that are moving to Florida. There's the weather there. There's a lot of people that are moving out of New Jersey, New York, that are selling their homes cash and coming down. And this is like our personal experience. It's not just a general statement, but we've got a lot of buyers that have been selling their houses off for 7, 8, 900,000, coming down and buying a brand new property for $350,000. Obviously, the weather is way better. I live personally in Ohio, and I love Ohio, but I like Florida a lot better.
Sure.
I have to say, like for the last year, the real estate market has been so crazy overheated where, when we put a property on the market, whether it be Florida or even Ohio, for example, because I listed and sold all my single family rentals, we would have 6, 7, 8 offers. People were going way over asking. People were offering contingency waivers where if we went above appraisal, they would provide that gap. And right now, we're in Florida where we're selling our houses. We're still seeing a massive demand. We're not seeing 8 offers. We're not seeing people going 30,000 over, but all the houses that we have under construction that we are listing within 7 to 10 days so far, we've been putting everything under contract. That's what we've been experiencing in our specific market in Central Florida. So when I say Central Florida, I have 2 partners. They live in Orlando, and it's Palm Bay, Marion Oaks, Ocala. Those are the areas that we're concentrating building. They're markets where there's a lot of opportunity for growth. They're markets that are affordable. It's crazy to say this, but for like a first and second time home buyer in those markets, $300,000 to $400,000 is kind of like the entry point in getting into that product right now. We don't want to have the risk of going on the coast or building a $3-4 million home, or we're not into those types of markets. We want to be in the bread and butter, the simple, easy product that there's the largest demand for.
Yeah, no, it's smart too. I mean, it's definitely a challenge. I mean, when I was doing a lot of retail realtor stuff, a couple of years ago when kind of COVID was in full swing, and we're having a lot of people coming down from New York, and I work in like the Jupiter area, which is kind of a higher end market, more expensive homes, and I have a lot of people that would want to be in Jupiter, and then the price thing would hit them. They'd be like, well, we can't in this, so they move up north a little bit, like Port St. Lucie or like into those areas, even up towards where you guys are in Palm Bay, because it is more affordable and you can get a lot more house for the money, and they're great areas, and they are good areas. We just underdeveloped. They haven't really got there yet. I mean, I think a lot of it, like you were saying in 08, there were so many neighborhoods that were started, and just when they stopped, they just, empty land for the next decade. And a lot of those are starting to come back. And those, I know, and you guys buy a lot of your lots. Or where do you guys get all your lots from? I know we talked about this before.
Yeah, so then that's a huge, and that actually wraps into one of our questions here from Craig here. What are we doing to pivot over the next year? So up north in Ohio, where I live, and many other areas of the country, what builders have to do is they have to buy, acres and acres of land, and it takes about a year to get the approval to be able to put a subdivision in, and then it takes about another year to put the streets in, the hydrants, gas lines, water lines, and provide the full infrastructure. And then they have to put a model home, so that's another 6 months. And then from there, so it's a very long process to start from the point of finding a lot, getting it to the point that it's developed, getting models up, and getting those properties sold. And back in 2008, a lot of really established builders in my area went through a lot of financial hardships because they were sitting on millions and millions of dollars of land that had no cash flow. It's just absorbing enormous amounts of cash every month to maintain the payments and the expenses. But when the housing market became more difficult, they had all this expense, but they didn't have the cash flow coming in. So that was a learning lesson that we really wanted to learn from and not ever be in that position. So down in Florida, what we're doing is we're specifically looking for existing lots that have utilities and existing developments where we don't have to do the development work. So that's a huge thing that sets us apart. We can buy those lots $30,000 to $40,000, sometimes even a bit less, but we can close in 30 days, apply for a permit, and get building, where we can be very nimble. The real thing that we really want to do, where we want it to be different, is run very low overhead, run very conservative, build product that really appeals to the masses, but just to be nimble. So this has been analogy somebody mentioned to me a while ago, but we want to turn like a jet ski with the market, not like the Titanic. You get too big, you get too much overhead and employees and developments. It gets really hard to be able to shift the market. We're light, we're nimble. It's just DK, Jason, myself, and then we have one additional. We had Erica working with us with our investor relations, and she just went back to school full time. So we have Renee that's coming on board, but We just run really nimble and really light. So we currently have 40 homes that are under construction, and we have a total of 95 lots that we currently own right now. And those remaining lots are going through the permit process, so then we can get those properties, moving as soon as the permits come in. But we're constantly looking at the job sites and looking what are hangups, labor, material, inspections, and at various phases throughout the last year and a half, there's been a hangup at each one of those points. So we're literally boots on the ground and trying to find out what is the solution to run this more efficiently, keep our costs down, and just keep the projects moving. So, that really, I feel for us, has been a big advantage for us. Keep our expenses very low, keep us at affordable price points, and just constantly observing the business, be able to make decisions as we move along.
So you're builders, how have you avoided running into all the supply chain issues that a lot of builders out there have experienced, and all these different problems that have been out there? How have you guys been able to keep going?
Absolutely. So we have a very unique situation down in Florida. When I was building custom homes in Northeast Ohio under my company, I was the general contractor, project manager, and I had to touch every single piece of that job site, meaning permits, rough in materials, invoices, labors. I had to touch every single piece of it. We've been able to partner with an amazing company down in Central Florida called ODC Construction, and they're known as a shell contractor. So they come in and actually provide all the general contracting work, material, labor, supplies, the first year of warranty work for the homeowner, but they have massive scales of efficiency. They're on track this year to build 12,000 homes, and they built 7,000 homes last year. So the largest builders down in Central Florida, which would be like D.R. Horton, Lennar Homes, are also utilizing ODC for all of their construction. So can you imagine that you're going to your suppliers and you're negotiating with the buying power of 7,000 to 11,000 homes and what that provides? Have we experienced setbacks and delays? Absolutely, we have. But the buying power and the size of the organization that we have really gives us priority. For example, the truss manufacturers down in Florida, a lot of the independent smaller builders that are just strictly on their own, they can't even get in the order queue to get trusses in, whereas we can because we have that relationship. So that's been a huge advantage for us.
Yeah, no, I thought that was genius. Just the idea of, if you call and you know that your suppliers and we're doing 12,000 homes this year,
Yes.
they're going to be, you're going to be our top, you're going to be top of the list of getting the supplies when you need them. So that's really cool. All right, so you have 40 homes right now that are being built. You have 95 total lots that you're going to be building on very soon.
Yes.
So let's talk a little bit about how people in the Private Money Club can get involved with you, what that looks like. Are you now you raise money for all those at once, or you do individual houses, or what are you guys doing with investors?
Yeah, so what we've been doing over the last year and a half is we've been taking an investor, and basically each house is approximately $200,000. Sometimes it's a little bit more, sometimes a little bit less. And we've been, and basically we would either allow one investor to come in if they wanted to take the whole project down, but the majority of our investors wanted to come in with small investments. And what we would do is we would combine 3, 4, 5, 6 people, however many necessary, and we would create notes and mortgages, and then we would file those with the county. So we actually, one question that just popped up there is we do not have a minimum investment amount. And the reason we did that is it was just a strategic decision that I made years ago, and it's worked out very well. So I found out if I were to have a minimum of, let's say, $100,000 investment for somebody to come in, there's a lot of investors that just wouldn't come over because either they didn't have 100,000 or they're just, testing the waters out and they're just not comfortable with that dollar amount. And I don't see the reason to stress people and pressure people to try to commit to something they're not comfortable with. So we've always let people come in at a dollar amount that's comfortable with them. And in my apartment days, I had somebody come in at an investment of $5,000, which didn't really provide us much of any benefit. $5,000 in an apartment, we could spend it in a phone call. But it was a relationship, and the relationship is what mattered. So then he had referred me to a friend of his, and they've invested about 850,000 with us, but we would have never seen the 850 if we didn't take the 5. So, to answer that question that came up in the chat, we don't have minimum investments. Right now, we're probably about 2 weeks out from having our PPM, or private placement memorandum, completed and wrapped up. And that's going to allow us to streamline the investment process. So there's going to be a PPM that we can send to our potential investors. They would sign the subscription agreement. And then at that point, the funds would come in, and then it would just really allow the whole process to move along faster.
What does lending to you look like? What are the terms typically? The length of time, what percentages usually are you offering, like things like that?
Yeah, so if someone's looking to invest into one of our projects, generally we're putting together the note and mortgage for a period of 12 months. So we go through the process of just jumping on a call, just introducing myself, what we're doing. We have an investor packet that we can send out. We also have a list of references. And the next part is something I say to every single investor that I have a conversation with. The biggest risk of this investment, it's me as the operator. And this goes for me or anyone else that you're looking to bring money to. That person, their integrity, morals, and values is what matters the most. So you want to get references of people that have invested with that individual. It's about $20 on the internet to get a background check from that person. It's a wise $20 to spend just to know who you're working with. That's not to say that somebody could have had a mistake in the past, bankruptcy, something that could be explained, but there's a difference between that versus an unexplainable event. 80 lawsuits, for example, is not a really clean explanation. Right. So that's one thing I say that because I was going to privately invest with somebody. I did a background check, and that's what I found out. So, and he had like 13 single family rental properties and owed like $250,000 in back taxes. Like, how does that? It doesn't even make any sense. So the second thing is you want to then look at is what is the experience of that person? Because if they're brand new in the business, they don't know what they don't know. And the last thing is, what is the asset class? Is it self-storage, mobile homes, single family, fix and flip? Every property, every project has a different risk allocation, different benefit. So basically take your time and make sure you're comfortable with that person. And if you want to move forward with it, basically at that point, what we do is we would introduce you to Renee, and she would help just set up with any paperwork that would take place with her PPM and or note and mortgage, depending on the timing. And then if somebody's working with a self-directed IRA, then we will assist with that process. Once the funds come in, we will send an investment check out for 6 months worth of interest. And then what we'll do at that point is once the investment is completed, which is a year or less, just the remaining balance of the interest that's accrued in that meantime, we'll just pay out at the closing. We do have some investors that have utilized like an equity line or a loan from their 401k where they'll have a payment that's tied to it. So if that happens, then we can make accommodations and provide more frequent investor payments. But if somebody's working with a self-directed IRA and they don't need access to funds, most people have been fine just receiving a one-time check of 6 months worth of interest in the beginning. And the interest rate that we're paying is 12%. So
12%, and then you're flexible on how it can be returned depending on where the money's coming from, what they need. That's cool. So the new PPM is going to be basically just a fund that's funding all of these deals, where more of like a private fund as opposed to like a mortgage and promissory note.
Yeah, and the other thing that was going to provide the biggest benefit is when it comes time to sell that house and the payoffs, because that's been a very cumbersome process right now. So let's say if we have 5 investors on a property, we have to mail them the sign-off release. They have to not only sign that, but they have to take that to a bank to have it signed in front of a notary. Then that's got to get mailed down to a company. So if we're trying to coordinate, potentially 3, 4, 5, 6 people in a house in those circumstances, it just makes things a lot more cumbersome for everybody. So it just makes the process a lot more streamlined, and just for legal protection too. It's the better, more correct way of raising capital.
Yeah, no, absolutely. So with the PPM, are you going to use for the full 12 months at that point, or will it be paid back possibly sooner depending on the closings that you guys have, or what do you see that happening?
Yeah, so even though we'll write it up for a period of 12 months, most of the time the investments are wrapping up sooner than 12 months. But the benefit of that is it just provides flexibility that if you wanted to pivot to a different asset class. You have that availability versus if you were investing in traditional apartment syndication, your funds can be locked up for 5 to 10 years, which is a pretty lengthy amount of time. But if somebody's happy with their experience with us, as long as the market conditions are safe and the business and everything is safe, we will continue to have more investments. And at some point, that's another point I just want to say. The 20 years I've been in this business, real estate, it has its cycles, its ups and downs. And when we see new construction becoming less favorable, there will be another opportunity, and the PPM is going to give us some flexibility that we can transition. Jason, DK, and myself, our experiences so far have been building new homes, flipping, wholesaling, full rehab, single-family rental portfolios, apartments. I have a self-storage facility. Really, mobile homes is the only thing we really haven't touched. So our focus is new construction, and our goal is to continue that for as many years as the market cycle allows us to perform that. But the biggest concern we have is not our profit margins, it's our investor relationships and the preservation of their capital. In all the years of doing this, I've made a lot of money. I have lost a lot of money, but I have never lost money for an investor. We've always maintained our payments. We've always maintained, and I think the big reason for that is the first 15 years of being in the business is when I self-funded everything and made those lessons on my dime. And the best way to learn a lesson is to lose money. Like you will never forget that lesson. You don't want to be making those mistakes on someone else's dime.
Right. Yeah, no, absolutely. I mean, it's one of the reasons why I always feel so very comfortable, especially when I have like newer lenders that don't really know how to underwrite, the investor, doing everything you're saying, and pulling background checks and Google checks and, digging into them a little bit and learning about them. But, whenever I do trainings on here, it's all like, we always talk about underwriting the deal is very important, but underwriting the investors even more so important. I always say start with the investor.
Yes.
If you're comfortable with them, then the deals are going to make sense because they know what they're doing. And the fact that you do have the 20 years of experience, that you've never lost money for an investor, you've always been able to preserve their capital even times when you've had rough times or lost money yourself, and you're still paying out 12%. I mean, that's a pretty good deal right there. I mean, there's a lot of new investors in Private Money Club that are trying to pay 12%. And I usually tell them, like, if you're new, you're going to have those pains of making mistakes. And because like you said, you just don't know what you don't know. And it can never, and that statement can't be truer than anything else in a real estate investing, because there's just so many moving pieces. I mean, not only moving pieces, but the markets, so there's just a lot to it. So having that experience and often that, I'm always like, you guys should expect at least 15%, maybe more, or even partner on deals with people when you're brand new to it. So the fact you guys are at 12, that's the only reason. We have another investor in our network we send a lot of new people to, because Noggle helps them. But this guy, Chris Rude, he does a lot of deals with us. And but same thing, he pays 12%, and he's, they do tons and tons of deals too. So that's what I love having you in the Private Money Club with, Jack, and I appreciate you being in there. So with that being said, so these you still got a few more minutes, right?
Absolutely, yeah.
Okay, cool. So again, if anybody has any questions or anything for Jack, please put them in there. I mean, I want to answer you guys' questions and have you part of the conversation. And if you don't, I'll keep asking questions because I love this stuff.
Absolutely.
Oh, here we go. Here's one. So for Jack, if person lends 100,000 rather than smaller amounts, do you negotiate with the lender concerning a possible higher interest rate?
Right now, the largest investor that we have has 1.6 million with us right now, and they're also receiving 12% on the capital. So we really don't have room to negotiate on that. And I feel like with the experience that we have, and for the safety of the investment that we have, that we're providing, whether through the PPM or we're recording the mortgages, investment, the experience of the team, I feel that it's a pretty aggressive return, especially in today's markets right now. I know of other investors that actually are pulling back their returns because they can, and we just don't want to do that. If we brought people in at 12, I don't want to go back and try to nickel and dime and try to get somebody, squeeze them down to 9. It's just we're in this for the long game, the long term, not for the one or two hitters.
Right. Well, there's two things there, that I agree with you on that. And actually, it's very generous, like you're saying, to offer the 12, because you're not trying to entice, be like, I'll pay you more interest, but you got to give me more money. It's almost,
Sure.
like a greed type thing. Like, you're like, let's build a relationship. If you're more comfortable starting smaller, we know that when you're ready and comfortable and have the means, you'll do more with me. I'm not doing it because of the interest rate. I'm doing it because of the relationship, which I really like. And you're also not saying, I'll pay you 9 if you have your money with me for 12 months, but if you lock in for 3 years, then I'll give you 12 or 15 or something. You're like 12, just everybody's the same. It's a 12-month term. You're probably going to get paid back sooner. And it's just, that's the way it is for everybody. And I kind of like that too. I mean, like with the other private fund, the cap fund that Chris and Andrew have right now, the latest one, it's only at like 6 or 7% or something for 12 months. And to get the higher rate, you got to go in for a longer term. Now that's a little bit different. They're doing commercial, smaller loan to value, stuff like that. But it's it's you got to lock in longer. So I like what you guys are doing with just, it's flat for everybody, and let's build that relationship. And then what happens in the future, we'll talk about that at that point. So really appreciate that part of it.
We have access to some Wall Street capital that we've been using. It's 8%, and the other benefit is we only pay on it as we draw, which overall it's a much less expensive capital. But we've built this business with our private investors and relationships, and again, there's just those relationships, and they mean more to us than again just trying to save $6,000 on a house. Not that we're not for saving 6,000. We're not for abandoning those relationships over 6,000. It's long term. It's not worth it for us.
Right. All right, cool. So right now you guys are focusing on the housing, like the new construction. That's kind of where your focus is, right? As a company, as investors, that's what you guys are focusing on. Now, are you constantly looking, or at least like kind of keeping an eye on the apartment complex market again, or?
Yeah,
what else are you kind of keeping an eye on?
We're always just scanning the horizon to see where are we going, how much more runway do we have, and then where does that next opportunity make sense? So what I've been focused on for the last 4.5 years is what we call value-add apartment investing, where I'm buying a property that's financially underperforming. Commercial apartment buildings are valued based upon the net operating income that they produce. So the more cash they produce, the more they're worth. Versus single family homes are based more upon appraisals, what your neighbors had a house had sold for, the house down the street. So on the apartments, we're specifically looking for properties that have low rents, low occupancy, deferred maintenance, absentee owners, where we can go in, we can remodel the property, rebrand it, raise the rents upon having that new image that improves our cash flow. Then we can refinance the project and pay our investors off. So what's, for the last, prior to 2020, we really did well. Yet we picked up a lot of great deals. But then once 2020 started happening, what ended up happening is the acquisition prices of apartments were climbing up aggressively. Materials going up, labor is going up, rates are going up. So I have all four going up at the same time. And I didn't have comfort that I could get my investors cashed out. I'm completely comfortable and bullish with the market, with the principles of apartment investing. It was just, I didn't have the comfort that I could get my investors capital return. So that's why we had made the transition. So right now, speaking about the Florida market, the things that we're looking for, because again, we're always wanting to pay attention to the market conditions to help guide us on the next 50, 100 homes that we can be building afterwards. So we're trying to look so we want to take a look at days on market. How long are our properties or other properties sitting in the market? And right now, because of the lack of inventory, properties are selling still very, very fast and aggressively. So we're comfortable with that metrics. We're doing our own specific marketing to bring buyers in. And right now, the amount of marketing activity and leads that we have coming in has maintained. We're also going to our lender and asking our lenders, like, what are you guys seeing? How many applications do you have coming in? Have you seen a fall off of applications? Because that's something that we're going to be able to get data pretty quickly on. If we're just waiting to read off of news articles, like, that really doesn't provide us the best benefit. We want to have like live data for where we're at specifically. So one of the things that was interesting when we're talking to our lender, he said that the applications for existing homes and new homes have maintained consistently. But what has fallen off, which makes total sense, is home refinances. with the rates going up, people are not going to be refinancing to pull equity out of their house, which makes a lot of sense. But if you just isolate to news articles alone, you'll read where they'll say, mortgages, or loan applications are down 30%, but that data really is skewed. So, in every market is going to be a different dynamic, again, based upon the area, the state, location. So, for the area that we're in, we're very comfortable with everything and where everything's going. But at the same time, our eyes are wide open in scanning the horizon for future opportunities. Another thing is my partner, DK, he is also an attorney. And he's a full-time real estate investor. And he's got relationships with a lot of foreclosure attorneys down in Florida. And he's just recently, within the last week, was asking, do you see it, a buildup momentum on foreclosure cases? And there's nothing right now. So it's good for the market, but those are the different avenues that we're focusing on to just pay attention to everything.
Yeah, no, absolutely. And DK and Jason, your partners, just so everybody knows, I know them, relatively well also, and they'll definitely be coming on Money Club Mondays because each of them kind of have their own little specialty when it comes to what you guys do.
Yes.
So I definitely want to bring both those guys on here in the near future also, and just introduce them to the Private Money Club and everybody too. Because up to now, Jack, you've kind of always been like the forward facing, in front of the members and everything like that. So, but bringing your partners on, I think is a good idea also. So we'll do that. And then I think you just wrote that, but is that the best way for people to contact you? Is just your phone?
Yeah, my cell phone, honestly, I still kind of just prefer to jump in the phone with people and introduce myself and answer questions. I just found it a lot more effective than text messaging or even emails. Again, my partner DK, he's also an attorney, full-time real estate investor. The attorney of him is extremely risk averse, and that's how, if you want to be an attorney, your mind has to function that way. Kind of like if you want to be an engineer, you're going to be extremely dialed in with all the specifics and fact finding and details. So, DK's experience, but his background and his legal background has provided a huge advantage to us. And then our partner Jason also owns the brokerage in which we're selling all of our homes for. So he's negotiating the lots, and he has his hand on the pulse at all time of the markets or buyers. What are they looking for? So it was probably about 9 months ago, and this was a strategic decision. The Fed had announced rates were going to be going up. There was no secret to that. So what we did is we started building homes that were a bit smaller, so people can get about everything they want out of a package, but we can keep the price point down a little bit lower because we're backing off of the square feet. So
right.
The homes that we build, and I didn't mention this before, they range anywhere between 1,300 square feet to 2,000 square feet. So we're really focusing on that first and second time home buyer experience. And we had transitioned a lot of our stuff from 2,000 square feet, backing that down more into the 1,600 square feet again, just trying to just pay attention and be able to be flexible with the market.
Yeah, no, they're beautiful homes. I mean, I came up and saw them, whenever that was last year.
Yes.
Up in Palm Bay, and I know DR Horn and Lamar and all them, and they're great. They're great homes. I mean, down here in Florida, they're very well known. They're your typical, solid CBS house. What are they? Mostly 322s or?
Yeah. So in Florida, for those that are familiar, we have very high water tables, so everything's on a slab.
Right.
1 or 2 car garage, 3 or 4 bedroom, and sorry, my little one decided to jump in here with us. That was little when he's 2 years old. And
future investor.
Yeah, exactly. He's gonna run the show someday. He already is right now. We just don't let him do the investors. But yeah,
you guys are always down here visiting Florida too. I mean, you're always down here, so
yeah, we are. Yes.
Yeah, you guys know. But yeah, I mean, they're typical Florida houses. Now, I know you guys have a newsletter that you send out. I get your emails all the time. That's all good. Do you guys have a website too, or how do they get on the newsletter? Like, how do they get on your email list? So just so everybody knows, so Jack is what I would consider a VIP borrower investor within the Private Money Club. So if you guys are in Private Money Club, he's in there. I got to get you more consistent posting deals and stuff, but
Sure.
We'll work on that. Maybe connect with Renee when she comes on board with you. But the bottom line is Jack's in there. So what he's doing right now, this is kind of a preview of the types of investors we have in the Private Money Club. That's why I do Money Club Mondays. Is this is open to the public, so this isn't just members only. So if you are not a member yet, go to privatemoneyclub.com. You can become a premium member and get access to not only the deals that Jack has available regularly, but also all of our other borrowers and investors that are in there. And we have about a handful of borrowers that are similar to Jack, with similar experience, similar to the types of properties and things that they're doing, and as far as what they pay out and stuff like that. And then there's many more investors that are either newer or things like that. So there's a broad range and a lot of options in the Private Money Club for lending and the types of deals. It's all real estate, but that's what the Private Money Club is. So we put Jack's phone number, but do you guys have, or how could they get that newsletter or continue to follow you outside of that?
Yeah, absolutely. So the name of our company is FL Pro Builders. That's the entity. And if somebody just wanted to just shoot me a message, I can just easily get you added to the email list. And then Renee really is the one that right now that's handling all of our investor relations. But generally what I do is I have everybody first like funnel everything through me. I can just kind of give a recap on what we're doing. And we've got a Dropbox link that that's another thing we do is we send out a newsletter every Friday. And again, you don't have to be an investor to receive the newsletter. Like anybody is welcome to come into that. And then we have a Dropbox link. So if somebody were to invest with us, every house that is under construction, we have a folder. So within that Dropbox link, there's the counties that we build. Then you click on the county, and then you can actually locate the house that you've invested in. And we have to update the photos about once a month. So you can clearly see month to month what's going on with the progress of the home. And beyond that, we're also available for phone calls and any questions. We've had some investors that have wanted to come down and meet us in person. We can accommodate that. We've had some that wanted to tour their specific homes. So, whatever that process looks like for people to be comfortable with us and what they're doing, we're flexible with.
All right. So one question, we kind of hit on it before, but how many projects do you typically have active at one time? Do you plan to slow or speed that up anytime soon?
Yeah, so right now we've got 40 currently under construction. We have about 20 of those homes which should be wrapped up and going under contract this July and August. So from those investors, their capital is going to most likely be rolled over into the next set that we have permits that we are in the process of applying for. And right now we plan on maintaining about this level right now. We know that we're going to have another interest rate hike in July. That's possibly going to be another 0.75 of a rate increase of the Fed increasing. It doesn't directly, when they raise the rates 0.75%, it raises the rates, but it doesn't necessarily go up exactly 0.75%. But it is going to raise their mortgage rates. So then they're talking about September about another rate increase, and the Fed is really just wanting to look to see if inflation is going to start pulling back before they start easing up. At least that's what they've told us at this point. We do have the elections coming up in November, and historically, anytime there's any sort of like political elections going on, things always generally become better somehow magically. So I really don't anticipate much going on around November. And then again, what's going to happen next year is just a guessing game at this point. But the fundamentals of the price points, the location, the migration of people that are coming down, looking at loan applications, looking at days on market, looking at the amount of marketing activity that we're receiving, everything we're comfortable with. But we don't want to get into building and overextending ourselves and building 300-400 homes at the same time, because that's not the right decision right now for that. So let's just stay and maintain, and then adjust accordingly as the market conditions point out, and as the fog becomes more clear.
Yeah. So let's say you have let's say you have 50 lots that are ready to be built on.
Yeah.
And you see things start to slow and you get a little uneasy. Will you look at dumping those lots or just holding them until you kind of feel confident in building again, or what's kind of that plan?
Sure. Really, we're at such a low cost basis on those lots. We really have the option of doing either holding or we could start to offload those. But that's the beauty of why we're investing in individual freestanding lots, and we're not developing a 200-acre parcel property. If you're D.R. Horton, if you're Lennar Homes, if you're Pulte, if you're Ryan, you really can't function on a model of buying individual lots. Like those builders rely on having massive developments, but they also have massive overhead. And that's really where we want it to be different. We want it to be small. We want it to be nimble. The other thing is if you compare our house, the same square footage of what we have versus our competitors, there's a dozen items that we've done as upgrades included in our price. We have taller ceilings, granite countertops. We have tiled showers instead of fiberglass. We have nicer tile in the floors. So, those are just a few things, but we really try to have those key upgrades that are included in the price. So if somebody's looking at our product versus a competitor, we clearly visually have a better product. But on top of that, the price points that we're selling, we're also an interesting buying perspective for hedge funds. Like it or not, hedge funds have invested billions of dollars into the single family real estate. One of our houses were just sold to a hedge fund. So our product appeals to first-time home buyers, second-time home buyers, people that are looking for, a snowbird type of a property. Our houses are affordable where they could be turned into a vacation rental. We can turn them into a rental if we wanted to. We have hedge funds as another buyer pool. So we have multiple exits and multiple buyer groups in what we're doing. And that's another reason why we focus in what we're doing, and we're staying away from semi-custom and custom homes.
Yeah. And that kind of reminds me of something else we were talking about the other day, I believe, was when you actually do sell to the buyer, because weren't you selling before, like at the beginning of the process, and now you guys are waiting more towards the end or something of that nature? Could you share on that?
Yeah. So, we had pre-listed some products in the very beginning, and that really was not advantageous for us because, if we lock in a price and we're holding and honoring that contract, and what we've seen for the last year and a half is each month the price of real estate just can give up and up and up. So, we had a few homes where we didn't make nearly the profit we should have because we locked in too early. The other thing is for a lot of our buyers too, when they're looking to buy, they really have a preference of having our occupancy permit in hand so that they know for sure when they can move into that project. If somebody's moving from out of state or they're relocating, they're trying to get in between the school years or whatever the circumstances is, if we get held up 1, 2, 3 months, that really becomes a problem for that buyer. If somebody's relocating from New York, New Jersey and coming down, there's really minimal to no options of where they can stay for 3 months until the house is wrapped up. So once we have that occupants, that certificate of occupancy, we absolutely have more buyers and more committed buyers at that point because they know they have that date.
Yeah, they're ready to go. Yeah, that makes sense. All right, very cool. Do you do any commercial properties in Florida, depending on market conditions?
Right now, we don't. It's so funny because in Ohio, there's stickers and and it says "stuck in Ohio." It's like the reason you stay in Ohio in the Midwest is because your friends and family and everybody are here. But the advantage of Ohio, the advantage of the Midwest is we're able to buy cash flowing properties at much more affordable prices. I bought hundreds and hundreds of apartments at $30,000 a unit, where in Florida, you're not touching anything under 180, and you can go north of 350,000 a unit. They're nicer properties, but 30,000 versus 350, there's quite a difference there. So the pricing right now in the commercial market has just been too overheated, too expensive for us to make sense of it. But again, real estate, it goes in cycles, and when the opportunity, when it presents itself and the deal makes sense, we absolutely will pursue those. So many buyers, would wish to be back at 2.5%, 3%. But if you wanted 2.5%, 3%, you need to buy 2 years ago. If you take a look at historical interest rates throughout the last 40 plus years, with the exception of a few years ago, we've never seen 2 and 3% rates, and it's unlikely we're ever going to see that again.
Yeah.
So, as they're going up, and it's funny because I'll talk to friends and family, and when they'll talk about in the 80s when they were paying, 14, 16, 18%. Like it's amazing, but people made it happen. So 6% still is way better, or 5 to 6% is what I'm saying, is still a lot better than 14, 15, 16%.
Yeah, I think you're right. if things really get really bad and the Fed's got to drop rates again, it's kind of getting that vicious cycle. And then at some point they're going to have to rip the Band-Aid, let things correct themselves and go from there. But this zero interest rate environment has just been, in my opinion, a nightmare, man. It's I mean, you punish people that save money, you encourage people to take on more risk. It's just the whole thing seems backwards. The advantage goes obviously to the banks and everybody. I mean, there's no money anywhere anymore in savings accounts and things like that. It's created a tough environment. You know, cheap money, but it's hard to make it anywhere. So what you guys are doing is so important, though, with the volatility we're seeing right now in the stock market and all the changes. I mean, what you guys doing really is so important, and having you as a place to be able to stick money in my opinion, relatively much safer environment than a lot of the other options that are out there. It's so important what you guys are doing. So keep up the hard work, man. I really appreciate it. I know a lot of the members in the Private Money Club have told me, thank you so much for, having people like Jack in there that they feel like they can trust you. And your background. Did you mention when you were a firefighter, right? For many years?
Yeah, I was a fireman. So I did that for 15 years. And I was running my real estate business. I was running our general contracting at the same time and did that for a lot of years. And we also built my wife's business. And we were never the type to just kind of sit back. We grew up from families where if you wanted something, you had to earn it. We always had enough food. We always had great shelter, great family, but our families, our parents, they didn't have a lot of money. So if I wanted a bicycle, if I wanted whatever, I had to earn it. If I wanted a car, so I look back and I'm very thankful for that. So it kind of created an entrepreneur bug in both my wife and myself, and we just always had that drive, and it's been a real blessing. So when I got in the fire department, I wasn't content just to work my 24-hour shift and just sit back for 2 days. So that's why I've been always involved in something. But I got to a point when I was about 14 years in the fire department that I didn't want to have the regret of being at retirement age, typical retirement age, look back and say in the last 20, 25 years, what would have life looked like if I actually would have pulled the trigger? When I left the fire department, it was a huge decision because you cannot be any older than 31 years of age to get on. And I was like 37. So when I left, when I pulled the plug, like there was no going back. If this didn't work out, like, I was a paramedic, but the option as a paramedic is working private ambulance, making a third of the money. Like it's a terrible occupation compared to what I had, as far as if we're comparing benefits and pay, not the job, but the pay and benefits, no pension. So like I was losing my pension, my healthcare benefits. I mean, it was a big decision, but again, I didn't want the regret, and it was 100% the right decision.
Yeah, no, it's when you eliminate that safety net sometimes and rip the cord, it's all or nothing, and that's kind of what drives people to the success that they have. And then, like you said, through all the learning experiences of making mistakes, kind of puts you in the place you're in today, which is a cool thing. I look back on it when I was a financial advisor and decided to give up my licenses, like the Series 7 and 66. And after taking those tests the first time, there's no way in hell I'd ever do it again. It was a nightmare. And so looking back saying, I remember the day when I was like, do I do my continuing education and keep these things going just in case I ever want to get back into that? Or do I keep going on the route I'm going? And I decided to let it go and never look back. And a little bit different, but I know what you're saying there, where sometimes you make those pivotal decisions in life and that takes you to where you are today. And it can either be a great thing or sometimes be scary though along the way. Do you know Rob Fuller?
Rob Fuller, I don't know.
Okay.
There's a chance we might be Facebook friends. I've got a ton of real estate operators and owners that I'm friends with, but at first I don't know him.
Yeah, Rob's another one of our VIP borrowers in the Private Money Club. He does developments though, so that's the biggest thing. Mark was just asking on here, is there any similar different areas in their operation? So Rob is more big developments. Jack, like you're saying, does 40, 50 houses, but they're individual lots. They let them be a little bit more nimble. I know Rob, as far as on the investment side, he wants 100,000 minimum. To him, it's not worth it less than that, and he will pay you more. If you hit that $500,000 or $1 million mark, like we just talked about with Jack, he says, I want to build a relationship and treat everybody the same. So just small little things, and there's nothing wrong with either way of doing that. It's personal preference on the operator and what they want to do with their investors in the future and what that looks like. So that's all. But both both you guys are really, really incredible real estate investors. A lot of experience there for sure. And you guys will have to meet at one of the events one day.
We'd like to.
Actually, we should do that, Jack. I need to talk with you. I should bring you out to Sundance in October for our next mastermind. We're going to launch the official launch of the new private money club in October out there. So
I'd love to make it. That'd be great.
Yeah, remind me about that. We'll talk about that.
Awesome.
All right, cool, man. Well, I don't see any other questions coming in. I think that was really, really good. So, Jack, I really appreciate your time. So I'm going to put your information on here one more time.
Perfect.
So everybody's on, you guys reach out to Jack and at least get on his newsletter, follow along with him. We'll make sure that he continues to post in Private Money Club. But yeah, take us home, Jack. Let you sign out.
Well, guys, thank you very much. Again, my phone number, I posted it, but it's 440-552-8483. I said, feel free to reach out to me. We'll schedule time. We'll connect on a call. And if you just got questions or just anything, if you want to invest, if you just want to learn, it doesn't matter. We value everybody's time the same.
Yeah, I mean, start small if you want to, or, we have a lot of people I talk to that, they just did a self-directed. There's not a lot in there quite yet, or maybe they certain amount that's a little bit remaining. Like, this is a great solution for that.
Absolutely.
So I'm going to call you with my $300 later, Jack. All right.
Exactly. It's awesome.
No, but for real though, it's start small, whatever, and go from there. But Jack, I really appreciate everything you do, and especially for your time here today. And it's great being friends with you, my man.
Perfect. Thank you. And thank you everybody for jumping on. I really appreciate it.
All right, guys. All right. We'll see you guys. Have a great week. We'll see you soon. Have a great 4th of July next weekend. No money clubs next Monday. It'll be 4th of July. Enjoy the day. Stuff some fireworks. Have some fun. We'll see you guys on Money Club Mondays in 2 weeks. Other than that, have a great week. Thanks.
Thank you, guys.
See you, Jack.